Welcome to ZZ Financial. We're committed to providing the most accurate, valuable, and timely information and analysis.
And hello, everyone. It's Sunday, August 31st. Right now it's 10 p.m. Eastern, 7 p.m. out west. Wow, looking at the news today, it feels like a real whirlwind. We've got the Fed battling inflation, big shifts in global trade rules, and even Japan's pufferfish are making headlines. I'm really curious, what are the sort of hidden gems, the connections you're seeing in all this seemingly random news?
That's exactly the challenge, isn't it? Our goal here is to help you cut through that noise, to find the threads connecting these events, whether it's the price of your groceries, the big strategies playing out in boardrooms, or even where you might go on vacation next. We want to dig into not just what's happening,
Right.
but why it matters and maybe what kind of questions it raises for what's coming next.
Okay, perfect. So let's start with that really hot topic in the U.S. economy, inflation. The latest numbers for July, the personal consumption expenditures, or PCE index. Well, the core number accelerated to 2.9%. That sounds specific, but what does it actually tell us? Why is that the number making waves?
Good question. So the core PCE, that's the one that strips out the, let's say, bouncy food and energy prices. It's really the Fed's favorite yardstick for underlying inflation.
Okay.
Seeing it tick up from 2.8% in June to 2.9% year over year. Well, it matched what the market expected, but it definitely signals that those price pressures are sticking around. They're persistent.
So it's like the economy still has a bit of a fever.
That's a good way to put it. It underscores the challenge the Fed is facing. And you see the reaction in the bond market, too, right? The 10-year Treasury yield popped up to 4.23%, partly because of these ongoing inflation worries.
Right, okay. But here's the part that feels a bit, counterintuitive. Despite this sticky inflation, we're still hearing a lot of talk about the Fed cutting rates. Maybe soon, like Fed Governor Waller hinting at a quarter-point cut in September. How does that square?
It seems contradictory on the surface, definitely. But the market is, it's strongly leaning that way. There's over an 80% probability priced in for a 0.25% cut at the September FOMC meeting.
Wow, 80%.
Yeah. And Waller's reasoning points to the other side of the Fed's mandate jobs. He specifically mentioned worries about the labor market starting to weaken. So it's a balancing act. They're trying to gently tap the brakes on rate hikes or even ease off slightly because they see potential trouble brewing in employment.
Ah, okay. So it's not forgetting inflation, but worrying about maybe overdoing it and hurting jobs.
Precisely. Waller was clear, though. He cautioned against bigger cuts. It's about being measured, trying to navigate this narrow path between controlling inflation and avoiding a sharp economic downturn, a hard landing.
Okay, that makes more sense. But then there's this other layer, which I have to say feels really interesting, maybe a bit messy. This ongoing trial about former President Trump dismissing Fed Governor Cook. How does something like that politics, potentially pressuring the Fed, feed into all this? Does it affect how markets think about inflation down the road?
It absolutely does. This touches on a fundamental principle, central bank independence. The idea is that the Fed should make decisions based purely on economics, inflation, employment, without political interference.
Right, keep politics out of it.
Exactly. But when you have events like this trial, it raises questions, concerns about whether that independence might be eroded in the future. If markets start to worry that, political goals could influence monetary policy, then they might anticipate looser policy down the line, which could mean higher inflation risks long term. This uncertainty, this potential threat to the Fed's autonomy, it ripples through the markets. It can make long-term bonds less attractive, for instance, and it also boosts the appeal of assets seen as safe havens, like gold.
Ah, so that's why gold's been doing well. It hit a 3-week high recently.
Partially, yes. It's acting as a hedge against that uncertainty, against the risk that maybe, just maybe, future policy won't be solely focused on keeping inflation low. If economic uncertainty keeps rising, we could even see gold challenge its record highs.
Interesting connection. Okay, so speaking of the Fed's balancing act and potential rate cuts, the U.S. Argus jobs report coming out September 5th is being called extremely important. Why is this particular report getting so much attention? Is it like a final exam for the Fed's next move?
Final exam is a pretty good analogy, actually, yes. The employment statistics, we're talking non-farm payroll numbers, the unemployment rate, wage growth, these are the absolute key indicators for the Fed right now.
Okay.
They offer the clearest picture of how the labor market, and by extension, the whole economy, is holding up. Any big surprise in this report, way stronger or way weaker than expected, could really shift the Fed's calculus on rate cuts and trigger some major market moves.
I remember last month, in July, The numbers slow down fast, and they revise past months lower. The market seemed a bit shaky at first.
Exactly. It caused some initial jitters, then the narrative quickly flipped to, oh, this means the Fed will have to cut rates more aggressively. So yeah, this report is critical for setting the tone, for shaping expectations about how fast or slow the Fed might move. It's a real tightrope walk for them.
Definitely sounds like it. Before we get that big jobs report, are there other clues we should be looking for this week? Any other data points that might give us a sneak peek at the U.S. economy's health?
Yes, this week is actually packed with relevant data. We'll get the ISM Manufacturing Index, which tells us about activity in the factory sector. Then there's the JOLTS report, job openings and labor turnover survey.
JOLTS, right.
Yeah.
That shows how many jobs are open.
Exactly. It's a measure of labor demand. And we also get the ABP National Employment Report, which is sometimes seen as a preview, though not always perfectly accurate, of the official non-farm payrolls number. Each of these pieces will add to the puzzle, giving us a clearer sense of whether the economy is resilient or maybe starting to fray around the edges.
Okay, so lots to watch even before the main event on the 5th. Got it. Let's switch gears now and look at global trade. There's been a big change with something called the de minimis rule, the tax exemption for small imports being completely abolished. What exactly was that rule, and why did the U.S. decide to scrap it? Sounds like it might affect me ordering stuff online.
It very likely could, yes. The de minimis rule basically allowed small packages, typically under $800 in value for the U.S., to enter the country without paying taxes or duties.
Okay, I think I remember hearing about that. Made ordering small things easy.
Right. It was meant to simplify customs for low-value shipments, which really helped cross-border e-commerce boom. But the administration decided to end it, expanding the abolition globally from late July. Their reasoning is twofold. One, to close loopholes they believe were being used to import illicit goods like drugs more easily.
Oh, okay.
And two, to capture tariff revenue. The estimate is that eliminating this exemption could bring in an extra $10 billion a year in tariffs. But, as you might expect, there are definitely costs associated with this move.
$10 billion is a lot, but I also saw a figure. Something like $10.9 billion in potential costs just for U.S. consumers.
What's that?
Well, like, we're the ones paying for it in the end. An NBER paper estimated $136 per household.
That's the finding, yes. The National Bureau of Economic Research paper estimates that burden falls largely on consumers. So while the government gains revenue, households could end up paying more for imported goods that used to slip under that $800 threshold.
Right.
And it's not just consumers. Think about the businesses built around this. We saw immediate reactions in the stock market. E-commerce platforms like Etsy and eBay took significant hits, down 15% and 9% respectively.
Wow.
Logistics companies like FedEx and UPS also dipped around 2% each on worries about handling fewer small international packages. Even big apparel names like Tapestry, the owner of Coach, and Lululemon are affected. Apparently, 50–60% of their U.S. online sales were often shipped from overseas warehouses using this exemption.
So it really ripples through the whole supply chain, huh? From the website I click on to the delivery truck to my wallet.
Precisely. It's a significant regulatory shift with broad consequences. And it ties into the bigger picture of tariffs under the current administration, too. Look at Caterpillar, the construction equipment giant. They just significantly upped their estimate for the impact of tariffs on their business this year, now forecasting between $1.5 and $1.8 billion.
Oof, that's a huge number for one company.
It is. It shows these trade policies are having very real, very substantial effects on corporate bottom lines, which, again, can influence prices or investment decisions down the road.
Okay, let's stick with the global picture, but shift to technology. Another ripple effect from trade policy seems to be happening in AI. China's Alibaba Group just developed a new AI-focused semiconductor. Given the U.S. export restrictions, how does a move like this stir the pot? Is this fueling that AI arms race idea?
It absolutely fuels it. You have the U.S., particularly under the previous administration, but continuing now, restricting exports of advanced semiconductors, especially high-end AI chips like NVIDIA's H20, to China.
Right, trying to limit China's AI capability.
Exactly. So what do Chinese companies do? They accelerate their own efforts. Alibaba, Huawei, others, they're pouring resources into developing domestic alternatives. This new chip from Alibaba is a clear signal. They're pushing hard to become self-reliant in this critical technology. It intensifies the competition, creates uncertainty for global tech investors, and, frankly, makes the whole landscape much more complex.
And we're seeing markets react nervously already, aren't we? Like Marvell Technology in the U.S. dropped almost 19% on weak forecasts. Dell mentioned slow orders for AI servers, and even here in Tokyo, Advantest, a chip testing company, fell nearly 8% after NVIDIA dipped. Investors seem incredibly sensitive to any hint of an AI slowdown or rising competition.
Extremely sensitive. The AI narrative has driven so much market enthusiasm, and valuations got, well, very high.
Yeah, definitely.
So now, any sign that the explosive growth might be moderating or that competition is heating up faster than expected, like Alibaba developing its own chip, it makes investors question those high valuations. It shows how much expectation was baked into those stock prices and how quickly sentiment can shift when new data or competitive threats emerge.
Got it. Okay, let's pivot now and take a look at Japan. The latest lodging stats for July.
Hmm.
They look a bit, disappointing. A 1.4% drop in total lodgers compared to last year. What's going on there? Is the Japanese economy hitting a bit of a wall?
It does suggest some challenges, yes. What's particularly noteworthy is that the decline happened for both foreign visitors and domestic travelers. Foreign lodgers were down 2.5%.
Oh, really? I thought inbound tourism was a big bright spot for Japan.
It has been. But some experts are now wondering if maybe that initial post-pandemic surge has peaked. Reasons cited include fewer repeat visitors compared to the initial rush, maybe the stronger yen making trips more expensive, and even some negative rumors circulating on social media affecting travel plans.
Huh, interesting. And domestic travelers.
They were down 1.1%, and that's actually the seventh month in a row of declines. This points more towards domestic issues, namely high prices squeezing household budgets. People seem to be cutting back on discretionary spending like travel. And look at tax-free sales data, too. A huge drop, down 36.3%. It suggests shadows over both inbound consumption, which was that rare growth driver, and domestic spending.
Okay, so pressure from both sides. And speaking of Japan, the yen has been acting, well, weirdly, right? You mentioned the link between the yen and the interest rate gap between Japan and the U.S. seems kind of broken. There's this theory about bad high interest rates. Could you unpack that? Why isn't the yen getting stronger if the rate gap is narrowing?
This is a fascinating and frankly puzzling development in the currency markets. Normally, yes, you'd expect that if Japanese interest rates are rising or expected to rise while U.S. rates might be cut, the narrowing difference should make the yen more attractive, pushing its value up.
Right, basic economics, sort of.
Sort of, but the bad high interest rates theory flips that logic. It suggests that the reason Japanese rates might be rising isn't because the economy is booming. Instead, it might be driven by concerns about Japan's fiscal situation, its large government debt, or maybe political uncertainty.
So the higher rates aren't a sign of health, but maybe a sign of risk.
Exactly. In that scenario, higher rates don't attract investment flows because they're seen as reflecting underlying problems, not robust growth prospects. So the traditional interest rate differential effect gets overpowered. That's why you have analysts like at Mitsubishi UFJ Morgan Stanley Securities forecasting the yen could actually weaken further, maybe to around 153 per dollar by year end, because they see strong underlying real demand for dollars globally, regardless of these rate movements.
Wow, that's complex. So a higher interest rate isn't always good news. Okay, what about Japan's bond market itself? Long-term rates hit a 17-year high, 1.63%. And there's talk of the yield curve steepening. What does that mean in simple terms?
Steepening just means that yields on long-term bonds are rising faster than yields on short-term bonds. So if you plot the yields on a graph against their maturity, the line gets steeper. And yes, yields on super long Japanese government bonds have been climbing, causing the steepening. Part of it is technical, maybe fewer buyers for those very long-term bonds right now. Part of it is speculation about the Bank of Japan potentially hiking rates later this year. The market seems to expect a 0.25% hike by December.
So expectations of tighter money.
Right. However, some asset managers, like Meiji Yasuda, think this steepening might not last. They figure that once we get past the mid-year portfolio adjustments in September, the pressure might shift to medium-term bonds, and maybe the government will issue fewer super-long bonds, so the curve could flatten out again. It's a bit of a tug-of-war between different market forces and expectations.
Always moving parts. Amid these broader economic headwinds in Japan, are there any specific companies or sectors doing well? I saw headlines about Mitsubishi Heavy Industries hiring big for next-gen nuclear reactors, and JR East selling Shinkansen trains to India.
Absolutely. Those are great examples of specific bright spots. Mitsubishi Heavy Industries is making significant bets on the future of energy and data infrastructure. They're planning a record hiring spree in their nuclear division, over 200 people this fiscal year. And they're also doubling production capacity for gas turbines, which are crucial for power generation in data centers. Their stock has responded positively to this forward-looking investment.
Makes sense.
And JR East's stock also got a boost after India confirmed plans to adopt their newest E10 series Shinkansen, the bullet train. That's a major win for Japanese technology and a significant infrastructure export deal. It shows that even with domestic challenges, focusing on specific growth areas like advanced energy or international projects can yield success.
That's encouraging. And what about things closer to, well, everyday life? I was intrigued by the news about pufferfish fugu becoming popular even at conveyor belt sushi places. And Workman, the workwear company, is having huge success with recovery wear. What's driving that?
These are fantastic illustrations of niche markets finding real traction. The pufferfish boom is interesting, it seems, driven by more stable catches, especially up in Hokkaido, where production has apparently doubled in 5 years, and recent deregulation making it easier and cheaper to process and serve.
Ah, so it's more available and affordable now.
Exactly. So chains like Kaiten Sushi Kameda can offer pufferfish dishes at reasonable prices, and apparently they've been flying off the shelves instant hits. It shows how making something previously inaccessible more mainstream can unlock demand.
Okay, makes sense. And the Workman recovery wear.
That's another clever move. Workman built its brand on durable, affordable work clothes. Now they're leveraging that trust to sell recovery wear clothing designed to help with fatigue or improve sleep. They've upped their sales target tenfold for these items, aiming to sell 2 million pieces.
Tenfold. Wow.
It shows they've tapped into a real consumer desire for wellness and self-care products, even within a tough economic climate. If you can offer a perceived benefit like better recovery at a reasonable price point, people are interested. It really highlights how innovation and understanding specific consumer needs can drive growth, even when the overall economy is sluggish.
Fascinating examples. Okay, one last area to cover as we head into September. There's always this talk of a September slump for U.S. stocks. Is that just, market folklore, or is there something to it? Should we be bracing for a rocky month?
It's more of an empirical observation than a hard and fast rule, but yes, there's historical data behind the September slump idea. Looking back over the last decade, the S&P 500 has actually finished September lower 6 times out of 10.
Oh, okay, so more often down than up.
Correct. And historically, when stocks do fall in September, the declines tend to be more significant than in other down months. Add to that the fact that current market valuations are still considered quite high. The S&P 500's forward price-to-earnings ratio is hovering in the mid-22s range. That suggests the market might be priced for perfection, making it vulnerable to disappointment.
So history plus high valuations equals caution.
Caution is definitely warranted, yes. It doesn't guarantee a drop. But the odds based on history and current levels suggest a potentially challenging month.
What's really strange, though, is the VIX index, the market's fear gauge. It's still pretty low, right? But at the same time, I read that bets against volatility, like VIX short positions, have surged to a 3-year high. How does that work? Low fear, but massive bets that fear stays low. What does that imply?
That's a very astute observation, and it highlights a potential risk. The VIX being low suggests traders aren't expecting big market swings in the near term. But this huge buildup in VIX short positions means speculators are actively betting, quite heavily in fact, that volatility will remain suppressed or even fall further.
Okay. So betting on calm seas continuing.
Precisely. Often, this is tied to the expectation we discussed earlier that the Fed will step in with rate cuts, soothing the market and keeping volatility low. But here's the danger. If something does spook the market in September, maybe that jobs report is a shocker, or some geopolitical event flares up and volatility starts to rise.
Oh.
All those short VIX positions become losing bets. People who are short VIX will need to buy VIX futures to close out their positions, and that buying pressure itself can push the VIX even higher, creating a feedback loop. It can amplify any market downturn, potentially leading to much sharper, faster declines than you'd otherwise expect.
Wow, so the bet on calm could actually cause a storm if things go wrong.
It could certainly exacerbate it. It's a crowded trade right now, betting against volatility. And when crowded trades unwind, it can get messy. Some strategists actually look at this setup and see a potential sharp drop in September as a buy-the-dip opportunity, but timing that is incredibly difficult. It definitely points to September being a month where vigilance is key.
Okay, definitely a month to watch closely then. Wow, what a journey today. We've covered the Fed walking that inflation tightrope, the huge ripple effects of trade policy changes, Japan's mixed economic picture with surprise hits like pufferfish, and now this potential September volatility trap. It really drives home how interconnected everything is in the global financial world.
It truly is. And if we try to connect all these dots, thinking about the bigger picture, it leads to a really important question for you, for all of us to consider. In an era where political pressures seem to be increasingly bumping up against central bank independence, where global trade rules are being rewritten, and even traditional economic correlations like the yen and interest rates seem to be breaking down, how should we, as investors, as policymakers, maybe even just as informed citizens, rethink our basic assumptions about how markets behave and what drives economic stability? It feels like the old playbooks might need some serious updates. Thank you for tuning in to Zizzy Financial. We'll be back with more insights next time.